Okay, our next speaker is Joey Garcia. It's my pleasure to introduce him and his session. Joey is the Executive Director, the Chief Digital Asset, and the Legal Officer at Xapo Bank. He acts as an advisor to the board of the British Blockchain Association in London and is an appointed university lecturer on the subject of DLT regulation for legal students. Joey is also a specialist consultant to the United Nations. He plays a critical role in shaping the future of virtual assets, DeFi, and regulatory frameworks, especially in Southeast Asia. His topic today is titled Building a Secure Bitcoin Reserve Strategy. Thank you, Joey. I'll leave you to continue the talk.
Great. Thank you very much for that. Sonia, let me just take 1 second. So hopefully you can see my screen. So I'll say to kick off, as someone who's been deeply involved in the ecosystem for many years, I've had the privilege, I suppose you'd say, of watching and witnessing the evolution from something that started as a niche technological experiment to, let's call it, a legitimate asset class that's been adopted by institutions and governments worldwide. So what I want to cover today is what are the essentials of building a secure Bitcoin reserve, focusing on, let's say, best practices for custody solutions, the cold storage related risk, and some of the disaster recovery planning. But also, we've got to address managing market volatility through, let's call it, the more advanced hedging strategies and risk management approaches that groups, serious institutions, and certainly governments need to take. So I think I'll say that the question at the moment isn't really whether organizations or governments are going to consider Bitcoin as part of their reserves. It's more a question of how to implement it securely and effectively, and whether you represent a corporation considering BlackRock's recommendations around the sort of 2% allocation to BTC, or a government that's exploring strategic reserves, institutional investor. The objective of what I want to achieve today is providing you with actionable insights for building and maintaining that. So this is a snapshot overview. Before we go into the kind of technical aspects of Bitcoin reserves, I think it's pretty obvious to say that it has very significant benefits as to traditional reserve assets. So there are several advantages that I think are becoming more and more apparent. So unlike gold, Bitcoin requires no physical storage infrastructure or security personnel, and unlike fiat currencies, it can't really be devalued through inflation by central banks. And unlike both of those things, it can be transferred globally in minutes rather than days. So full, final settlement finality around that as well. And I mentioned BlackRock before. They've been talking a lot around BlackRock, obviously a very significant investment institute, and their recommendation of 1.1 or 2% allocation to BTC and multi-asset portfolios is very interesting, particularly because of the risk contribution rather than the capital allocation. So they're saying, in a traditional portfolio of a mix of 60% stocks, 40% bonds, they categorize sort of 7 major tech stocks, accounting for a share of the overall portfolio risk, and they bracketed BTC in that same 1 to 2% allocation. They made lots and lots of statements around that, and I think that's getting a lot of traction. So that sounds very simple, all very wonderful, but when groups, institutions, corporates, governments are building reserves, I think that custody represents probably the most critical security consideration, and the evolution of custody solutions in the Bitcoin ecosystem, it's been pretty unbelievable. And it ranges from, let's call it, the self-custody hardware wallet to the more kind of institutional grade custody platforms would now have insurance coverage and the more complex regulatory compliance. But there are some sort of key factors, I think, that always need to be considered. So MPC, or multi-party computation technology, has emerged as a bit of a kind of revolutionary approach to private key management. So rather than creating single private keys that represent single points of failure, MPC distributes key shares across multiple secure parties. I'm not going to go into detailed MPC breakdowns, but that's core sort of functional system that maintains the degree of security that didn't exist one generation ago in the ecosystem. Wallet as a service, again, more comprehensive, secure, scalable solutions for managing digital assets, and they support like multiple wallet types in one sort of cohesive system. So they have custodial wallets, traditional third-party, MPC using what I mentioned, some smart contract wallets, so more programmable wallets with advanced features, and then exchange wallets for more kind of integrated trading platform solutions. And then you have the classic kind of cold storage. So cold storage, it's popular or can be popular for assets that you don't really need immediate operational interaction with, and their air-gap systems store private keys on devices that never, let's just say, connect to the internet, and they can provide a degree of security against remote attacks. But I'll talk a little bit more about that in a bit. And I think most specifically, when we talk about cold storage and people talk about it as being secure, it's sometimes it's worth remembering some of the Bybit related issues. So in February, that hack provided quite a kind of sobering case study in security failures, and led to the 1.5 billion value theft through very sophisticated supply chain attacks, where the attackers effectively compromise a safe wallet and modified the code, were able to modify the code to deceive the user. So that incident has highlighted several critical vulnerabilities, where there's insufficient verification redundancy, inadequate air gap signing procedures. There are dangers around blind signing multi-sig transactions without proper verification, and the wider kind of awareness of supply chain attacks, compromised developer machines, smart contract security, and then the kind of general human factor as well. And again, that can get quite complex, but there are lots of lessons that have been learned. And when we talk about security, I think those lessons emphasize verification redundancy with multiple independent verification systems and how important that is. Transaction limits or time delay withdrawals for large transfers, multi-party authorization requirements for approvals from multiple departments or entities, and regular audits by third-party specialists. So self-custody or self-control custody, or however we want to determine that, has potential advantages and also potential risks. And I'm not saying that in the sort of self-custody versus traditional third-party custody, there's an obvious winner, and the self-custody also provides a degree of security control, but it also offers some professional security infrastructure risk. So if we think about the big custodians in the world today and the amount of assets that they hold within the BTC ecosystem, you have to think about systemic vulnerability, security issues, legal pressures, preparedness for cybersecurity threats to such attractive targets. And then there are sort of the basic principle of the concentration of risk within one central custodian is also pretty relevant. So I'd say that multi-custodian setups are more standard across most platforms or larger groups at the moment, and I think that's a very important factor. From our point of view, in the systems that we've developed, having geographically distributed shard-based signing is kind of fundamental. Thinking about quantum resistant infrastructure, making sure that there can never be a single point of failure, no individual discretion whatsoever, and very, very secured cryptographic certainty only is kind of important. And again, lots of people are talking about this now, or they're talking about things. When we started building nuclear vaults in Switzerland as part of our own security arrangements, which we actually maintain as part of the MPC solution. That document, by the way, is dated 2013, so we've been operating since 2013. We were one of the biggest or the biggest Bitcoin custodian in the world back then. It's kind of relevant to know the counterparty and know exactly what it is that they're doing. And one of the things I'll show, because it kind of frustrates me a little bit, when people in this ecosystem use exchange platforms as custodians, not really understanding that they aren't really regulated custodian infrastructure providers. They can, people will mention Bybit, and they'll mention, FTX or whatever it might be. They sometimes don't realize things like this. So if you go to the exchange graveyard and start to take a view of failures within unregulated infrastructure exchange platforms that offer these kinds of solutions, it's more than a few. So this is 500 or 600 platforms that have gone by. These are not headline things, but they are, know your counterparty, or know your VASP, or know your infrastructure provider is something that I'd say is pretty critical. So that's what I would say. So beyond that, when we're talking about secure infrastructure, robust disaster recovery is critical for any form of Bitcoin reserve. And there are lots of key components of that. Multi-signature security protocols, I won't go into. I think I've mentioned briefly geographic distribution of key materials, but so there can never be a single physical disaster point that can compromise access to assets or funds. I mean, I would say keys should be stored in different jurisdictions, ideally on different continents, with different considerations: political stability, legal frameworks, physical security. Some organizations like ours maintains keys in specialized vaults designed to withstand natural disasters, electromagnetic pulses, or other catastrophic events. And also the more subtle points, so succession planning for key holders. You have to address the human element of key management with clear procedures that are established for scenarios where key holders are unavailable due to whatever factor might be: death, disability, departure. So that includes secure methods for transferring key responsibilities and legal frameworks for succession. And I say the other bits: regular testing, regular validation, documentation, secure knowledge transfer. So ensuring that procedures aren't dependent on any single individual's knowledge, and comprehensive documentation to be maintained for secure redundant locations, again with careful attention to balancing security with accessibility. And I'd say that disaster recoveries should address both technical and organizational aspects. So not just technical redundant backup systems and secure seed phrase storage with cryptographic time locks, but also organization measures to have clear governance structures, defined roles, responsibilities, and regular training. And that brings me on to, again, there's an asset, Bitcoin volatility is known. It's a persistent concern for potential institutional investors or governments. I think historical data shows that there have been 9 instances where the price has fallen over 40% in 13 years of existence. And there can be people that have longer term views. They can tolerate price swings, but organizations with fiduciary responsibilities or specific liquidity needs require more sophisticated approaches to volatility management. So dynamic hedging strategies and techniques have emerged as tools for institutional Bitcoin reserves. So unlike, let's call it, static hedges, where the ratio is set at the outset and then it's kind of unchanged, there are more dynamic hedging that involves frequent updates to hedge ratios to keep pace with shifting market conditions, and futures, and allow the sort of lock-in of that future price without reducing downside risk by taking short positions in futures contracts proportional to the Bitcoin holdings, price floors, the option strategies as well, cover calls that generate income by selling the right to purchase Bitcoin above a certain price, partially offsetting, let's call it, the cost of holding, perpetual swap contracts. I mean, there's a lot of stuff, and this is, I could talk a lot about this, but all I really want to say here is that there are volatility management and hedging strategies that do exist within the space now to kind of manage that. And when we talk about strategic reserves, I think this starts to become a bit more relevant, as does the comprehensive risk framework that I'd expect to be in place for Bitcoin reserves, and what should be included within that. So regular rebalancing, stress testing against historical volatility events, counterparty risk assessments, especially for the derivative side of things, the governance and processes around hedging decisions, and monitoring systems for real-time risk assessments. So that's all critical, and these are all kind of fundamental points for building a secure infrastructure to gain exposure to something that like BTC. And I think there's a lot of developing stuff as well. So the long-term price appreciation is the primary motivation for including it in any reserve strategy. But there are also more complex and more interesting methods to develop strategies to actually generate yields while maintaining appropriate security standards. So I suppose lending represents one approach, and it requires very, very careful counterparty risk assessments. Institutional lending platforms offer annual percentage yields ranging from 2 to 5% of Bitcoin deposits, with varying collateralization requirements and risk profiles. We have built our own fund, currently operates with around 3,500 BTC, which has been structured exactly, tested for 5 years with our own assets before we've deployed it within a Bitcoin denominated fund to allow some of our users to gain access to that, corporates, institutions, and individuals to gain access to a secure yield. Going beyond the security, you have the DeFi opportunities. The wrapped Bitcoin protocols that enable BTC to interact with smart contract platforms, some of the Bitcoin L2s, and the interesting stuff that's happening. And they can provide yields through different liquidity provisions or lending protocols or whatever it might be. But they have different forms of technical and smart contract risk that need to be very, very carefully evaluated. So I think that institutions, platforms, everyone is considering yield generating strategies whilst managing risk. And I think that organizations should conduct very rigorous cost benefit analysis of active management versus simply holding BTC. And the potential incremental returns need to be weighed against the increased complexity and operational costs and risks. So I would say, generally speaking, a tiered approach makes sense to approach this. And sort of towards the end or lastly, I'd say there are lots of different approaches to Bitcoin reserves. I have a lot of experience with the infrastructure in El Salvador. I won't go into all of that, and there's no need for me to touch on the US position, which I'm sure has been covered in a lot of detail. What I would say very quickly, though, is that the economic sort of rationale for government Bitcoin reserves, it has to be compelling when you even from a US perspective, when you consider the scale of national debt. I think in the US it's around 35 trillion in 2025. I think with interest payments alone exceeding $1 trillion in 2024. So it's the second largest budget item after Social Security. So if you think about traditional strategic reserves, in the US, you maintain a strategic petroleum reserve to ensure energy security, and a gold reserve to arguably support economic stability. So a Bitcoin reserve could certainly serve as a hedge against currency devaluation and strategic positioning in the emerging digital economy. That's a very US-centric position, but all governments are considering slightly different factors that they should and could consider around that. So I think I'm out of time. I've probably been talking too much, but just to conclude and summarize key points for building a secure Bitcoin reserve: custody is absolutely paramount. Institutional grade custody solutions with MPC, robust disaster recovery has to be there. Managing volatility risks strategically, considering yield opportunities extremely carefully, size allocations to be determined appropriately, and learn from other government and institutional approaches, because there is a lot to learn. And the landscape of Bitcoin as a reserve will continue to evolve. Regulatory frameworks are developing and maturing, and I think we'll talk about that in a session later today. But it's extremely exciting, and I'd say the traction is way beyond today what it was even a year ago, let alone 5 and 10 years ago. So the direction of travel is quite obvious, and you can see from the amount of discussion that's happening in the space how relevant it's become. So I think I will conclude things on my end, Sonia.